Welcome to the Deep Dive, where we try to cut through the noise and bring you the insights that, well, really matter from the latest reports and research. Today, we're plunging into a sector that's not just growing, it's absolutely exploding. The cloud GPU space right here in India. If you've been curious about, the foundational infrastructure that's powering the whole artificial intelligence revolution and high-performance computing, you are definitely in for an insightful discussion. Our mission today is basically to crack open the latest earnings call from E2E Networks Ltd. They're a crucial homegrown player in this dynamic Indian market, and we want to unpack what it tells us, not just about their current performance, but maybe more importantly, their ambitious future growth path, the broader industry outlook, and also the inherent risks they seem to be navigating right now. Just for clarity, all the financial figures we'll talk about are in Indian rupees.
That's right. We've spent some time meticulously sifting through the Q1 FY26 earnings conference call transcript from E2E Networks. Our goal really is to pull out the most crucial details, synthesize their strategic thinking, and give you a crystal clear picture. This deep dive, it's designed to offer you a genuine shortcut to understanding this pretty fascinating company and its pivotal place in what's a rapidly evolving high-stakes tech landscape. We're trying to look beyond just the headlines here to give you the strategics. So what?
Okay, all right. So to really get a handle on E2E Networks' journey and where they might be headed, let's start at the beginning. For listeners who might not be, super familiar, who exactly is E2E Networks? What's their core business in this specialized cloud GPU space? What makes them stand out?
Well, E2E Networks is primarily a cloud GPU player based out of India. They've actually got quite a history. They've been in business since 2009. They've really honed their cloud software capability since about 2014, and they've evolved to offer a pretty comprehensive package. Think of it as an all-in-one solution, really. It includes the raw compute power, the specialized hardware, essential support services, and even data center collocation if customers need it. They often talk about handling nearly 100 different activities needed to run a cloud properly, ensuring reliability, security, scalability. Their unique selling point fundamentally revolves around making it easier and, crucially, more cost-effective for customers to access high-performance computing.
So their main pitch is basically making GPU power accessible and affordable. Is that it? What's a specific value prop that really sets them apart for businesses needing these resources?
Yeah, what's truly fascinating here is that core value proposition. It's about delivering high ROI and presenting a significantly lower cost alternative compared to companies trying to set up and run their own on-premise GPU infrastructure. I mean, for many businesses, buying and maintaining a whole fleet of these high-end GPUs is just incredibly capital intensive and frankly very complex. E2E aims to take that burden away. And interestingly, for those customers who maybe for stringent regulatory reasons or specific security policies need to keep their data and operations strictly within their own physical premises or within national borders, E2E also offers what they call a sovereign cloud platform. This is basically their advanced cloud software packaged up for private on-premise operations. It's quite a powerful offering for sectors like finance, government, or critical infrastructure, where data sovereignty and control are absolutely paramount.
That's a really crucial distinction, especially in a market like India, where data rules are, well, always evolving. Okay, let's pivot now to their core business performance for this past quarter, Q1 FY26. What did the numbers actually tell us about how they performed, particularly given how fast things are changing in this sector?
Right. So the company itself characterized their Q1 performance as reasonably good, especially when compared to the previous quarter, specifically for their live revenue cloud business. Their monthly recurring revenue, or MR, which is, a really key metric for subscription businesses, it increased quite impressively to 14.5 crore rupees by the end of June. That's a solid jump up from 11.2 crore rupees at the end of the prior quarter. They've also apparently seen a significant uptick in proof of concepts those PACs and reported a much bigger pipeline for large GPU clusters. They mentioned some notable customer closures right towards the end of June too, so the underlying business activity, it looks pretty strong.
Okay, that MR growth, that sounds like a definite positive, but I noticed something maybe a bit contradictory in the financial highlights you mentioned. While that MR is up, the overall revenue actually dropped quarter on quarter, and they reported a net loss. That seems confusing. Can you help us connect those dots? Why the dip in the top-line financials, and what does it really mean for a company in such a high-growth sector?
That's a really sharp observation, and it brings up a absolutely crucial point for understanding these kinds of growth-oriented companies. While the MR for their live cloud business is definitely growing, you're right, the financial highlights for Q1 show that overall revenue dropped 12.6% quarter on quarter, down to 361 million rupees. And yes, they reported a net loss of 28 million rupees, leading to that negative EPS of 1.39. Now, this isn't necessarily a red flag or a sign of trouble. It's more a reflection of significant strategic investments being made right now. E2E is aggressively front-loading costs. It's almost like, a startup burning cash, but for rapid scale. They've deployed roughly 884 million rupees from recent preferential funds. That's capital specifically raised for growth. And this capital is going directly into expanding their GPU infrastructure, building out new data centers like the one in Chennai, and importantly, bolstering their team to handle future demand. So this investment, while it definitely impacts short-term profits, it's really foundational for their big ambitions in this booming market. They're aiming to secure a dominant position. Their EBITDA margin, for instance, still stood strong at 29.1%. That indicates underlying profitability before factoring in these specific aggressive investment impacts. It's a calculated bet, a strategic investment in future market share, not some sign of underlying weakness. They still have about 384 million rupees left from those funds for more expansion too.
Okay, that really clarifies the investment story behind those numbers. It's like they're building the highway before all the traffic arrives, essentially. Speaking of future traffic, this brings us nicely to their ambitious growth trajectory and the industry outlook. Where are they right now with their current GPU capacity, and what's the roadmap for expansion look like?
Indeed, they are laying down some serious infrastructure. E2E Networks currently boasts a total GPU capacity of nearly 3,900 GPUs across their sites. And as of the call, a significant chunk of that, nearly 3,000 of them, are up and running. They're operational for both actual production use by customers and also for proof of concepts. A big part of their growth story involves strategic geographic expansion, too. Their new Noida facility's GPU capacity is fully live, deployed back in May, and it's already generating revenue.
Right, so Noida's online. That's good news. But I seem to remember hearing about some bumps in the road with their Chennai deployment. What's the latest situation there? How does that impact their growth plans? That seems like a pretty significant piece of their roadmap.
You're absolutely right. The Chennai deployment has been a definite low point, as they put it, this quarter. This facility is pretty significant, accounting for 1,024 GPUs in single large clusters, which are incredibly powerful configurations for demanding AI tasks. The delay was mainly down to the inherent complexity of actually running these very large GPU clusters efficiently. It requires deep technical effort and really intense coordination with major technology and hardware partners. They've been working very closely with these partners to get it fully operational. They sounded hopeful it would be live by the end of July or perhaps early August. And this facility alone, once it's fully up and running, will dramatically add to their overall sales capacity. So yeah, getting it activated on time is pretty crucial for hitting those ambitious growth targets.
Wow, it sounds like a massive undertaking, almost like building a supercomputer from the ground up in some ways. Despite this Chennai hiccup, they still seem quite confident about their pipeline for new business. What's giving them that confidence, especially for these large GPU clusters?
Yeah, their confidence in the pipeline seems pretty well founded, particularly for those large GPU clusters, ranging from 32 GPUs up to 24 GPUs. They mentioned seeing quite a few larger POP-Cs, proof of concepts, convert in this range, which is a good sign. Based on their current capacity and projecting utilization hitting somewhere between 75% to 90%, they are targeting a really impressive exit monthly recurring revenue MR of anywhere between 32 to 38 crore rupees by the end of March next year. I mean, that's a substantial jump from their current 14.5 crore MR, right? It definitely indicates aggressive growth expectations for the near future.
And what about factors outside the company itself? Are there any big industry tailwinds helping them out? I'm thinking specifically about things like the India AI Mission Initiative. How does that fit into their outlook?
Oh, absolutely. Significant external tailwinds are definitely playing a role in the broader industry outlook, and E2E hopes to capitalize on them. They anticipate substantial business coming from the India AI mission, where E2E Networks is designated as an L1 provider. Now, for listeners, an L1 provider in this context basically means they're recognized as a top-tier or primary provider in this national initiative. They're trusted to fulfill a significant chunk of the mission's compute needs. While they said they've already seen some revenue from this, albeit smaller amounts so far, they expect a considerable increase in workloads to come their way in the upcoming quarters as the mission starts allocating its promised capacity more widely. Beyond just that mission, they've also been strategically expanding their enterprise sales team and their partner ecosystem. Apparently, this has successfully opened up new conversations and really propelled advanced discussions with a lot of potential customers. So it sounds like they're, firing on all cylinders to secure new business and broaden broaden their market reach.
That focus on the enterprise market and government initiatives, that sounds like a smart strategy for building stability. Looking even further ahead now, what are their plans for getting their hands on the very latest, the most cutting-edge GPU tech? Thinking about NVIDIA's next-gen chips, for instance.
They are indeed being quite aggressive, as they termed it, on capacity additions, with a very clear eye on the future of the hardware. They have concrete plans to invest in NVIDIA's upcoming Blackwell GPUs, specifically mentioning models like the B200s and B300s. For those maybe less familiar, these are NVIDIA's next-generation, most powerful GPUs. They're absolutely critical for pushing the limits on the most demanding AI workloads. E2E Networks highlighted what they described as a strong, early partnership with NVIDIA. And importantly, they stated they don't anticipate significant challenges in actually acquiring these advanced GPUs. They see themselves as one of NVIDIA's earliest and most strategic partners in the region. That potentially gives them a distinct competitive edge in the market.
So they're not just expanding capacity, they're aiming to expand with the absolute best-in-class technology. That's key in this field that evolves so fast. This brings up a really important question, though, about their overall long-term infrastructure strategy. How much room do they realistically have for major scaling, beyond what they've already deployed or contracted?
Yeah, this is where their long-term vision really starts to take shape. The Chennai facility, for instance, it's designed from the ground up to be a truly massive deployment. They mention it's capable of hosting up to 20,000 GPUs eventually. I mean, that's just immense room for future scaling. Noida, while maybe not quite on that scale, can still expand to at least 6,000 GPUs if needed. Overall, they've already contracted capacity for somewhere between 8,000 to 9,000 GPUs across these locations today. That shows they have substantial existing room for growth even before building out the full potential of a site like Chennai. They also pointed out a key detail about asset life. GPUs generally have a revenue-earning life cycle of about 6 to 8 years, and they strategically depreciate them over 6 years on their books. This indicates a pretty good, stable, long-term asset base for their operations. It suggests they're building for the long haul, not just the next quarter.
Okay, it's clear they've got an ambitious vision for scaling up. But of course, no deep dive is complete without properly looking at the challenges and the inherent risks. Companies, especially in these high-growth, high-investment sectors, they always face risks. We already touched on the Chennai deployment delay being a significant lowlight this quarter. What were the broader ripple effects of that delay?
Exactly. That delay was, as we discussed, a direct result of the sheer complexity involved in bringing these very large GPU clusters online smoothly. It required not just huge technical effort internally, but also intense coordination with multiple major partners, including the hardware providers themselves. This complexity directly hit their Q1 numbers because they started incurring the operational costs, the OPEX, for the new Chennai facility back in April, even before it was generating revenue. This effectively doubled their operating expenses for the quarter. A lot of that was due to strategic investments in building out the team needed for future growth and just the general ramp-up costs of the new location. Now, while they said they don't anticipate major OPEX changes in the next couple of quarters as the facility hopefully stabilizes, that initial ramp-up was definitely costly and certainly impacted their bottom line in Q1. It's one of the key risks of rapid expansion.
Right. Beyond the hardware deployment risks, what about their software licensing business? One might assume that's a big part of their immediate revenue strategy, especially given their partnership with a major player like L&T. Is that actually materializing yet?
It's interesting. They made it quite clear on the call that while they are engaging in many conversations and doing proof of concepts for software licensing, they are explicitly not putting a major revenue number on it for this financial year. They seem to expect that revenue stream to really come online and contribute meaningfully starting in the next financial year. Regarding L&T specifically, while E2E is definitely a technology partner and they certainly hope for synergies, they were also quite pragmatic. They noted L&T is a huge conglomerate that works with many vendors, so E2E's role isn't exclusive there. Their focus, they said, is on performing exceptionally well within the current engagements to hopefully expand into more L&T businesses over time. It's clearly positioned as a long game, not an immediate cash cow.
And the India AI mission, we talked about it as a tailwind for the industry outlook, but could it also present specific risks or challenges for E2E, particularly around, say, profitability or maybe resource allocation?
That's a really important consideration, touching on the potential risks. E2E Networks did acknowledge they anticipate some amount of margin contraction, specifically for business derived directly from the India AI mission. The reasoning is that because it's a national mission, there's an expectation that participants contribute maybe with tighter margins than typical commercial deals. However, they were quick to add They don't expect this to significantly impact the overall company margins across their entire infrastructure, as it's just one piece of a hopefully diversified customer base. There's also the potential risk, I suppose, of resources they've committed to the mission getting delayed if the mission's rollout slows down. But E2E mentioned they maintain live real-time data of their available capacity with the India AI mission team. This means if expected orders don't materialize on time, they retain the flexibility to deploy that capacity fairly quickly to other waiting customers, which helps mitigate the risk of having expensive assets sit idle.
Okay, that sounds like a reasonably smart way to manage that potential slowdown risk. One final risk area they touched upon relates to the actual nature of their customer workloads right now. How does that impact their revenue stability?
Yes, this is a really important point regarding revenue predictability, a key risk factor. Currently, they stated the majority of their large GPU cluster workloads are focused on AI training. Now, for listeners, training is where AI models learn from massive data sets. It requires really intense bursts of computation, but often only for specific periods, maybe a few months for a big project. This type of workload inherently tends to be lumpy, as they described it. A customer might need a huge amount of compute power for a project, then when it finishes, they scale down significantly. With a smaller customer base, which they have now compared to hyperscalers, this lumpiness is more pronounced. You get customers coming on board, using lots of capacity, and then potentially moving off or reducing usage. So they are actively working towards building a base of more stable inference workload customers, particularly focusing on the enterprise sector. Inference, remember, is where those trained AI models are actually used for real-time tasks like image recognition or language processing. This often requires a more consistent, steady demand for GPU resources, potentially year-long contracts. Shifting more towards inference clients offers a pathway to a more consistent, predictable revenue stream and helps mitigate that inherent lumpiness risk associated with purely training workloads.
Okay, so pulling this all together, what does this really mean for E2E Networks and maybe more broadly, the future of cloud GPUs in India? It definitely sounds like a company in a phase of high growth, high investment, taking some calculated risks for what they hope are significant long-term gains. They're projecting that impressive exit MR target of 35 plus or minus crore rupees by March 2026, and they anticipate their operating margins improving significantly, potentially reaching 65-75% EBITDA. I mean, that's a pretty bold target.
It is indeed a bold target, and it really highlights their unique and quite ambitious position in the Indian market right now. They firmly believe they have a long lead, as they put it, in GPU technology expertise, especially with their own software stack built specifically around Gen AI and GPUs, which they describe as production metal tested. This deep dive, I think, clearly shows a company that's aggressively expanding its capacity, actively pursuing strategic partnerships, and skillfully navigating the inherent complexities and, frankly, the significant costs involved in such a rapidly evolving technology landscape. So for you, the listener, maybe the interesting question this raises is this: in a world where AI infrastructure isn't just important, but it's becoming a foundational requirement for almost all innovation, how do companies like E2E Networks balance that immediate financial impact of making these massive strategic investments against the potential long-term rewards of becoming a truly dominant, critical player in a high-growth, high-stakes sector like this? It's a really fascinating balancing act to watch, especially as they push for such a substantial increase in their monthly recurring revenue, potentially shaping the very future of how AI gets done in India.